Hey everyone, let's jump right into today's explainer, because we are tackling something that quietly affects so many investors without them even realizing it. We're talking about an IRS rule that could literally be eating away at your tax deductions right under your nose. It's called the wash sale rule. And look, if you've ever tried to manage your own portfolio or do a little end-of-year tax planning, getting a solid grip on this concept is absolutely crucial to keeping as much of your own money as legally possible.
All right, part one, the IRS tax trap. Let me ask you something. Have you ever looked at a stock you own, saw the price was way down, and decided to just sell it at a loss to reduce your taxes? You take the hit, but you figure, hey, at least I get a tax break for my trouble. It's a super common, totally smart strategy to offset taxable gains elsewhere in your life.
But here's where the trap actually snaps shut. See, what you expect is this nice, clean, immediate tax deduction for the year you made the trade. But what happens if you aren't careful? The wash sale rule kicks in and the IRS completely defers your loss. That immediate tax benefit you were counting on, poof, gone for this year's tax filing. It's incredibly frustrating to think you've lowered your tax bill only to get caught up in IRS red tape.
So, what exactly is this rule? Basically, the wash sale rule is an IRS regulation that prevents you from claiming a tax loss if you buy a substantially identical investment within 30 days before or after the sale. Now, don't panic. Tripping this wire isn't illegal. Nobody is going to jail for a wash sale. It just frustratingly hits the pause button on the tax benefit you thought you were getting right now. The IRS is basically saying, not so fast, you bought it right back, so you don't get the loss today.
Which brings us to part two, the 61-day window.
And here is the reality check. The rule isn't just 30 days after selling. It's actually a 61-day window. This is the surprise reveal that catches so many really smart people completely off guard. Just calling it a 30-day rule is kind of a trap in itself, right? Because it makes you think the clock only starts ticking the moment you hit the sell button. But the IRS, they look backward just as much as they look forward.
Let's map out how this window actually operates. You've got 30 days before the sale, the actual day of the sale itself, and 30 days after the sale, 61 days total. If you purchase substantially identical securities anywhere within this entire timeline, bam, the wash sale rule applies. And here is a massive detail from our sources. This includes purchases made across multiple taxable brokerage accounts you own. So you can't just sell a loser in your Robinhood account and then quietly buy it back the next day in your Fidelity account to outsmart the system. No way. The IRS looks at the big picture across that whole 61-day span.
Okay, let's walk through a wash sale example to make this super clear.
Let's follow an investor named Sarah. Step 1. Sarah buys 100 shares of ABC Corp for $5,000. Step 2. A few months later, the stock tanks, and those shares are now worth $4,000. She sells them, doing exactly what we just talked about, locking in a capital loss. But then comes step 3. Just a week later, she gets a little FOMO, fear of missing out. She thinks, ABC Corp is actually still a really good bet. It might rebound. So she jumps right back in and repurchases those exact same shares. And by doing that, Sarah has completely stranded her $1,000 capital loss. She really thought she was going to get a sweet tax deduction this year. But because she bought the stock back just 1 week later, well inside that 30 days after window, she is legally barred from claiming that $1,000 loss on this year's taxes.
Now actually, scratch that. It's not totally gone forever. There is a silver lining here. The IRS doesn't permanently erase Sarah's deduction. What happens is, the disallowed loss is added to the cost basis of her new shares and deferred. They basically adjust her math so she can eventually claim that loss later on, whenever she finally sells those replacement shares in a qualifying transaction. So the money isn't stolen, it's just locked up in the future. But for this year's tax season, yeah, it's a massive disappointment.
Let's move into part 4, accidental triggers and dividends.
Because here's the thing. Most retail investors don't intentionally trigger wash sales like Sarah did. Usually it happens entirely by accident. You might accidentally buy the same stock in another account like we mentioned earlier, or maybe you completely forget about a purchase your spouse made because yes, the IRS absolutely looks at your combined household trading. Even a recurring investment plan like auto-depositing $50 a week into an index fund can accidentally trigger a buy right after you sold a larger chunk for a loss.
But out of all of these, the absolute sneakiest one is the dividend danger. Almost every long-term investor has their account set to automatically reinvest dividends. It's just a great way to compound wealth. But get this, a scheduled automated dividend that buys even a tiny fractional share of a stock counts as a repurchase to the IRS. If that microscopic automated buy happens within that 61-day window of your sale, you've just triggered the wash sale rule without even lifting a finger.
Let's connect the dots on how this set-and-forget feature causes a massive headache. Say you sell a stock at a loss. A few days later, a scheduled dividend auto-reinvests just $3 into fractional shares. Bam! Wash sale rule triggered. Now, because of that tiny $3 automated purchase, a portion of your loss is disallowed, your cost basis is completely adjusted, and your straightforward tax filing suddenly requires a crazy spreadsheet. You went from a clean tax deduction to a major headache, all because of an automated dividend.
So, Part 5, Avoiding Costly Tax Mistakes.
How do we fix this? Let's look at straightforward, totally legal workarounds to protect your tax deductions. You basically have two great options side by side. Option 1 is simple. Wait 31 days. Just let the window completely pass before you even think about buying that specific asset again. Option 2 is to buy a substitute. If you sell a stock but still want exposure to that industry, purchase a different investment that helps maintain your market exposure as long as it isn't substantially identical according to the IRS. You get to harvest your tax loss, but you stay invested in the market trend.
Wrapping this up, here are some rapid-fire best practices straight from our sources. Keep detailed trade records. Review your year-end transactions specifically to catch these accidental triggers before tax day. Be incredibly careful with complex setups across multiple brokerage accounts. And as always, if you're unsure, consult a qualified tax professional. Avoiding wash sales is really just a matter of timing and paying attention to your portfolio's moving parts.
I want to leave you with this final provocative thought. Look closely at your own accounts. Are your automated investments, your recurring buys, and your dividend reinvestments secretly costing you tax deductions? It's a question every single investor needs to answer. Check those settings, mind the 61-day window, and take back control of your tax filings. Thanks so much for hanging out with me for this explainer. I really hope it helps you make smarter, more confident moves in your portfolio going forward.